I think the big one for me, why it stood out, was our corporate clients. They want to be in a nicer area. They're professional people. So this one came up in a really nice area just outside of Bristol. Great transport links into the city, both 50 minutes on the car and a train. If you look into it, Bristol's been one of the top hotspots, if not the top hotspots for the last 20 years for growth. The yields were still, pretty decent and certainly above average.
Today I'm with James Davis.
Hi there.
James, so you've been with us just over 4 years now?
Yeah, about 4.5 years, yeah. 4.5 years, gone quick.
And the industry itself, you've been in there a long time?
Well, I've been in the industry 30 years, and sort of the first 15 years was more financial services, and then the last 15 years more on the property side,
Yeah, that's it. And the property investor yourself, as you'll see, a lot of our consultants have got their own portfolio as well. Quite important to us that you practice what you preach. So
definitely,
so to speak, with it. So I've asked each of the consultants to pick out a development, a property that stands out to them that you've sold over the last few years. James, I believe you've chosen Coates House.
I have,
Bristol.
Yeah.
So if you want to just, I suppose, talk through first of what was that project, what type of property was it, and the mechanics with it, and then we'll go into the why after that.
Yeah, so Coates House is one of the first, I think we've obviously only been sort of about 6 months when we launched that one. I think I was a little bit biased because you can probably tell by my accent. I'm from Bristol, and the property itself is just outside of Bristol. So I knew the area, I knew the Bristol market. I was very confident of the Bristol market. I think the big one for me, why it stood out, was short-term lets is quite hard to work when it's at a higher price. And sort of Bristol, you tend to be paying in a nice area, sort of £300,000 plus for a property, which makes it harder to work on short-term lets, unless you go to not such a nice area. And our corporate clients, they want to be in a nicer area. They're professional people. So this one came up in a really nice area just outside of Bristol. Great transport links into the city, both 50 minutes on the car and a train, but also great transport links to the motorway, literally 5 minutes off the motorway, just below Bristol, in a place called Knowsley. So I was really happy with the location, knew the area well. I knew it would be good for growth because it's in a nice residential area.
And you've experienced growth yourself on your other
exactly. And Bristol's always been, and if you look into it, Bristol's been one of the top hotspots, if not the top hotspots for the last 20 years for growth. It started, just a little bit of backstory, it started when people were priced out of London, and it was one of the fastest sort of commutes into London, basically just over an hour. So a lot of the people moved from London to Bristol. Sort of the big influx was when Lloyds Banking Group head office moved there, and it sort of spiraled off the back of that. So I was very confident with the Bristol market, knew it was good for growth. And what this one was being at a lower price, it was able to work well on for two reasons. One, on short-term lets, but also on a longer-term let, the yields were still pretty decent and certainly above average.
Which is something we mentioned on the property course. So try and have a look at both, because this type of property, as you say, it could be a traditional residential buy to let. You could look at it, you could put in a long-term tenant, or crucially, you could do short-term lets in it. So this opened up to both types of property investment really well. They were a block of completed.
They were completed, I think the majority were sold, about 50% were sold to residential buyers. I think the developer and then passed it over to us. I think just sold, through normal local estate agents and then passed it over to us with a discount, which we always try to get with a discount for us to sell it to investors.
And that model worked quite well. It's a good point that we sold to residential initially because it helps with mortgages. So a lot of the time when lenders go out, they like the fact that there is a home buyer market, isn't there, from it? So the fact we had those valuations already through in it really helped us. And as you said, James, we then got it at a discount.
About a 10% discount, I think it was.
Yeah, it was roughly that, wasn't it, below it. So one beds, if we remind what sort of price?
So the one beds were about 170, 180. Two beds were around the £220,000 mark. Everything on it was perfect. It was no ground rent. It was a 999-year lease. Nice high-end apartments with parking, sort of a 2-minute walk to the local town. And I think that's as well, sort of taking it to the back end. There's a good sort of one thing clients always say to us, well, what happens if it doesn't work on short-term lets? What happens if you don't hit the returns? Well, it had the backup of, the figure stacked up well on a longer-term rental. And then sort of the final point is what's the exit strategy? We knew and we were confident there's an exit strategy there, even to sell it on the open market to residential buyers. Number one, because they've done that. But two, it's got the ticks in the box, which is the transport links, did very good scores. It had a weight that the local supermarket was a Waitrose, which always tells a bit of a story of what type of town type of town village. So it sort of ticked every single box from location to everything about the property itself as well.
And it's another thing that lenders will look at as well.
Of course.
All that type of thing, what is their exit strategy? So as always, we kind of reverse engineer the deals. We look at the exit to look at it. And in terms of the actual process for an investor buying one of those apartments, so pretty straightforward this one because it was completed. It was a £5,000.
Simple, £5,000 reservation. Every I think I sold 5 or 6 in there. Every single one I sold to, obviously it could be open to cash, of course it would be. But every one of my buyers were a mortgage buyer, so it was a matter of £5,000 down, start the legal process, start your mortgage applications. Obviously we always have, in-house mortgage advisors if people need them. 25% deposit down. The legal work starts 6 to 10 weeks. And they pay the 25% deposit, draw the mortgage down, and they complete on that property. Obviously, leading up to that, our short-term let team are liaising with them, normally about sort of 2 to 4 weeks before completion, looking at how we're going to furnish it. So we're almost, I always say to clients, we sort of aim service standards from that day of completion to try and get that property live and a booking within 2 weeks. And there's obviously sometimes like internet and that may get delayed, but we've been doing it long enough now. We kind of know what we're doing, and it's a matter of, if we complete on that, we can get it furnished and get a first booking within 2 weeks. That's sort of what I always sort of aim for our service standards.
And because we sort of controlled the development, we know the sort of trigger points is right. When do you need to be looking at furniture? Like you say, introducing them at the right time to the short-term let team, but also at the same time advising on what it would be on a standard rental if investors out there wanted to do it. So there's a lot of options with this one. So let's fast forward then. Obviously that was the selling of the properties. So we now manage quite a lot of the properties in there through the gas short-term let arm. How are they doing? How are the results?
They've been doing really well. They've been doing really well. We started very, very strong, which quite often we do on the occupancy because it was a cold start. I think that's probably quite clear to say this was one of our more riskier ones because it was in a cold start. And whilst we've got another development now we're selling in Bristol, we know we're going to do well. This was our first one, wasn't it? In Bristol. So there was always that worry. And it started really strong. It started really strong. Occupancy rates for the first 6-12 months were brilliant. The nightly rate was slightly lower. Was probably about 15% lower than what we predicted. But quite often what we do is it's about driving that occupancy at the outset, making sure we get good reviews, make sure we're getting rid of any sort of teething problems. And
then you can push the nightly rate up then.
And then what we do is we push the nightly rate up and we are pretty much there now. And I've had a little look at today some occupancy rates. We're pretty much there on the occupancy rate and the nightly rate they are. I think we're averaging about 8.5 to 9% net return after all costs. Which is where we're going to be.
It's a good yield when you consider, as we said on the prices, you're talking, over 170, 180,000 pounds for these properties. So to be achieving, 9%. And these are net yields as well, aren't
they?
And
these are net yields. The only thing obviously to come out of that is the mortgage. And I think that's probably one thing worth bringing up because I had quite a variety of clients who bought them. I had some clients who were nearer retirement ages. That's probably quite good to cover. What type of clients bought them?
Who did it suit?
Who did it suit? And what actually they were trying to achieve. So out of my clients, a couple were nearer retirement. So what they were looking to do is they weren't necessarily looking to build a portfolio and get more properties. What they were looking to do is maximize their savings as quickly as they can to retire. So I had quite a few clients in there who, let's say buying one, let's keep the math simple, at £200,000, they're putting £50,000 down, they're 25% deposit. And we looked at, how quickly can we get that mortgage paid off? Because they weren't looking, for passive income now. They just wanted that mortgage paid off to have a mortgage-free property in retirement. And, looking on an 8%, 9% yield of 180, generate £1,200, £1,300 a month. And when we looked at it, and we are now achieving those figures, it was roughly about 12, 13 years. So the investment was 50,000, extras, probably all in £65,000.
Yeah.
So that £65,000 in 12 years was to be able to generate £1,200–1,300.
Yeah.
And if we compare that to a pension, the money you would have to be paying in to generate that is probably half your wage packet.
That's it, and it's not factoring in the growth as well. You got your bonus of growth, like
exactly.
we touched before with Bristol, how well it does on top of that. So,
and obviously growth on your income as well, so that goes up. So that sort of was a couple of clients who were looking to use their money to basically as quickly as they can have a pension income. And then obviously from other investors, we're looking to build a portfolio. So quite of those were looking at, say, a limited company, keeping that money within the limited company. And we worked out on that basis, if they didn't touch any of their income and profits, probably sort of 3 to 4 years, and that's even forgetting growth, they could reinvest that money to buy another one. And then obviously as they once again get near retirement and they've got the number of properties they want, to go from there.
This is how you then scale your portfolio
exactly
as well that way of it. But no, really good site, and it sort of led us, as you mentioned, to then look at more properties in the area, which we often do. Like you say, we get a foot in first, and then we see what the results are like, and we expand on it as well. But it was a really exciting development, that one. Like I said, passionate you were, because you were from there and stuff, and it's great to see it doing really well.